Hey, everybody, and welcome back to another episode. I'm your host, Brennan Cobb, and today I've got Clint Harris on the show. He's been investing in real estate for a long time. He's got over $100 million in stabilized asset. I believe most of that is in self-storage, what we're going to talk about here today. He's also the host of the Truly Passive Income podcast. Clint, welcome to the show.
Thank you, sir. Great to be here. Great to connect with you.
Yeah, so jump right in. You were telling me about this deal y'all did where y'all converted a Kmart to a self-storage facility, $4 million project, $9 million valuation. What in the world? That sounds like a home run.
Oh, we're just going to jump into it, huh? Let's rip it. All right. I like it. Yeah. So that was after a long history of doing things the wrong way and getting burned out with non-effective strategy, I made the switch to storage. And yeah, the first one we did was in end of 2020, beginning of 2021. We bought a 87,000 square foot Kmart building in Reidsville, North Carolina for 1.5 million. We put 2.5 into it, so we're into the project for 4 million, and stabilized valuation is a little over 9 million once converted to climate controlled storage. And then that went really well. We did another one after that, and then a handful more after that, and kept going.
I didn't know Kmart's were still around.
Man, there was 2,000 Kmart's at one point in time. They're all gone, but there's still buildings that are continuing to pop up that have been getting paid out through the bankruptcy. We closed on we've done 3 Kmart conversions. The second one was in Danville, Virginia. We were into that one for 5.5 million and we sold it 37 months later for 9.53. So that was just a quick turn on that one. And then the third one we just closed on about 2 months ago. It's a Kmart that closed down in 1983. And has been a lot of things since then. Most recently was a call center, which got put out of business by AI, obviously. So it was a giant call center building and then 24 shops in a retail strip mall. We bought the whole thing, converting the old Kmart building to storage and refacing the rest of the retail. So, think about it. Who wants 100,000 square feet of retail big box space these days?
Who's your buyer? I mean, you got
Yeah.
what, like Home Depot, Lowe's, Walmart? I mean, that's it.
Yeah. But
And
honestly, in
chances
that
are they're already in
situation,
that area.
they are. They're already right there. And a lot of times it's just honestly easier and cheaper from them to build for the ground up. That it's not easy converting these buildings, but the reality is if you and I go build a self-storage facility from the ground up right now where we operate in the Southeast, it's going to cost us $130 a square foot for the construction, plus the cost of the land. And it's going to take us 2.5 to 3 years to do the entitlement, permitting, engineering, and construction.
Yeah.
And then it's empty and we got to fill it up. Or we can buy one of these old vacant buildings. We're buying these buildings for like less than 20, 25 bucks a square foot. It includes the land and the parking lot. We're doing the construction for about 45 bucks a square foot. We'll be all in average 65 to $70 a square foot with the land and the parking lot. And it takes us 10 to 12 months to convert it.
Yeah, it's insane. We do a lot of development. We do entitlement, I do development, and I do new construction. And yeah, that's the problem is the permitting, the fighting with the city. Anything can happen with rates while that's going on,
Yeah.
construction costs, supply chain issue. There's a lot of hurdles to overcome with new construction. We saw all of it in 2023, all at the same time. But that's insane because you said you bought the building for 1.7 million. You couldn't build it for anywhere close to that amount of money.
At the time when we closed on it, the replacement cost just for us, and we're unlimited licensed GCs, by the way. This is the cost of building it. If we wanted to build that 87,000 square foot shell, it would have cost us $6.5 million, not including the land basis. And instead, we got the land, the parking lot, and the building for 1.5. Now, it was in horrible shape, but that's our business. We want to look for the ugly ducklings that we can turn into golden geese. So the bigger, the uglier, the nastier, the better.
Now, how did you know that the area was going to be able to absorb that amount of storage space?
Yeah, we didn't. And so that's why we implement something called a feasibility study. And now we
Mhm.
do a feasibility study in-house as well. And I know you know this, but for the sake of the listeners, it's basically a third-party study. It can be a desktop study or on-site study, which is even better. That's going to look at what's the residential density in a 1, 3, 5, and 7 mile radius? What's the traffic count? The number of percentage of renters versus owners, average age, median income, people per household, the amount of storage in the area, the price per square foot, market saturation, how much more is already put into permitting and maybe coming down the pipeline over the next 2 to 3 years. So there's a full-blown feasibility study that has to go into it. But think about where these conversions are. And we do Class A ground up development as well, but our primary strategy is the conversion. We've converted Kmart's, grocery stores, warehouses, textile mills, boot factories, carpet factories, soda
Mhm.
bottling facilities. We're looking for big buildings, great visibility, great residential density in a 3 mile radius that's kind of right on the main thoroughfare a lot of times. And somebody is just ready for someone to do something with the old, whatever, fill in the blank, Kmart, furniture store, whatever it may be, right? And so that building's typically been sitting empty there for years. At one point, it was a great spot for the people of that community to go buy their home goods there. But Amazon and Walmart have basically put that out of business. But the location still makes great sense for those same people to drive back to the same building. Those same cars still pass by there every day. And then the feasibility study is going to help us confirm that it's actually going to work in that location. But one of the beautiful things is even if a competitor can find the 5 to 7 acres to come in and build a competing site, it typically is not going to be right next to ours because a lot of times we're kind of right in this urban core in these smaller secondary, tertiary markets. And even if they do find the space, the land basis is higher and it's going to take them 2.5 to 3 years to build it. And we're going to be well on the way to stabilization before then.
Wow. Very interesting. So taking old buildings, converting them, and creating self storage out of them, which it's not going away. People, in fact, I've seen with the rising cost of construction and the lack of affordable housing, builders have been building smaller homes and
Yeah.
people are downsizing. Baby boomers are downsizing. They don't want the big house and big yard to take care of anymore. And it's really pushed a lot of opportunity into the self storage space.
Yeah, you're making a good point. In fact, I would make a case that I'm gonna make a comment here not to sell storage to anybody, but that people just probably need to be aware of if you're thinking about investing into storage. Before we started recording, you and I were having a conversation about multifamily and how it's been a tough space over the last few years. And I have multifamily investments too. Since the interest rates shot up at the end of 2022, it's been a very challenging space and rents don't always continue to go up. Even in Austin,
Mhm.
Texas, rents are coming down now. So in the self-storage space for the last 35 years, it's the top performing commercial asset. Now, whether or not, no matter how you feel about the consumerist society that is America, I think there's certainly, you know, some morality things that are questionable about how much stuff we keep and how many we think things are somehow tied to happiness. And I think that's another conversation. But at the end of the day, when you thought storage, you used to think baby boomers and heirloom furniture and
Yeah.
bulky stuff and Christmas decorations. But that's changing because the average consumer used to be in a storage facility 2 to 3 times a year at the most. The millennial population is in and out of a storage facility more than 2.8 times per month, and they are using it completely differently.
Why
The
is that?
cost of living is a big reason. Um, when you own a house, depending on where you are in the country, you have an attic, a garage, a basement. Renters traditionally use more storage than owners. Right now,
Mm.
the millennial population is a renting population, unfortunately. First time home buyers are now in their early 40s. Used to be you were married and having kids in your late 20s, early 30s, and that ship has sailed. So the reality is the new consumers are using storage, but they're using it differently. Instead of paying for a 2 bedroom condo for $1,800 a month, people are paying $1,300 a month for a 1 bedroom condo and then getting a climate controlled storage unit as an extension of the closet, extension of the garage. They've got winter clothes in there. They have lifestyle items like bikes and snowboards and mountain bikes. These people need to be able to get in there Saturday morning and get their waders and their fishing rod and their kayak and get out of there. And so they're in and out a lot more. And so the number one question that I originally had when I was just an investor was, is this asset class going away? And it's not, because the millennial
Yeah.
population is now the largest population segment in our country. It's 28% of the population, and they're using almost 38% of storage now. It's the largest population segment for storage as well. So tragically, as the cost of housing has gone up, the necessity for storage for you to keep your stuff in a way that you don't have to pay for an extra bedroom that may cost you hundreds of dollars per month.
Mm.
You can use a storage facility instead, as long as it has good location, good visibility, and easy access, climate controlled, touchscreen kiosk, QR codes, things like that.
Yeah. The automation technology is never better, and I'll get to AI here in a second because it's hard not to have a conversation around
Yeah.
automation without introducing some sort of AI. And I'm curious how y'all are using it in the storage space. But real quick, kind of backtracking a little bit. This weekend, I went to Atlanta and I went to the Greenbelt. There was development there called like the Ponce development, and they had renovated a 1.1 million square foot old Sears Roebuck into just an insane amount of restaurants and retail stores. I mean, it was really cool.
Some open air
The
stuff. Is that,
vision that they
yeah.
had. Oh, there was a rooftop little amusement park. It was
Yeah.
crazy. And as I'm walking around, cool thing they did was they left a lot of some of the original equipment and walls and stuff like that, just to kind of give it that old vibe. And in my head, I'm like, dude, we can barely keep a job site clean on a new construction single build project. Like, how in the world did they renovate this building without somebody accidentally destroying something that's supposed to be kept there? It's absolutely amazing. So, what I'm curious is when you're renovating these big buildings that have been around a while and you're deciding what stays, what goes, how do you make a decision on what's going to get, renovated and pose a risk because it's too old or maybe there's some
Mhm.
structural defects with it, versus, you know what, we're going to keep this because this is kind of cool and there's no reason not to.
Yeah, that's a really good question. In fact, you're kind of highlighting the track record of what we've learned along the ways, because it used to be, how do we get into this at the lower price per square foot? And it's a little short-sighted to do it that way. The real question is, how do we build this with the exit in mind? And a lot of times we're stabilizing properties. We'll buy a property for here's oversimplification. We'll buy a property for 2 to 3 million. We'll put 2 to 3 million into it. We're going to be in the project somewhere in the 4 to 6 million range. As a stabilized climate controlled self-storage facility, it's probably appraising in the 12 to 15 million range, maybe a little bit more. But that's going to allow us to do a cash out refinance, pay out all of our investors, leave everybody in the deal so it's non-taxable. Nobody has to pay a bill because there's no capital gain. And then we continue to hold it long term. And in that scenario, it's like, okay, well, let's just hold it long term, get in there. It's just going to print money and cash flow forever. And we can take the depreciation and the benefits, and that's great. But that's not always the case. Sometimes, like is when the interest rate shot up at the end of 2022, we had multiple projects that got behind on where they were supposed to be in lease up. Self storage has been leasing up at 3% occupancy per month for 30 years, with the exception of 2008 to 2010 and the last couple years, right? Because we've had this depression. We're coming out of a self storage recession because storage is tied to the housing market. And the brakes got slammed on the housing market when the interest rate shot up 2,100% at the end of 2022. We're climbing out of that now. But the reality is, if you ever like, you know what, we're behind on this project, we want to sell this early, which is what happened with the Danville, Virginia project I told you about. We were $5.5 million in on that project. We had a great offer come along, and 37 months later, we sold it for 9.53 million. We beat all of our investor projected returns, and we rolled on to the next one, rolled that capital into another deal. And the reason we were able to do that is because of the question you brought up and the way that our answer changed over time. Instead of getting into it with the lowest basis to try to save all the money for the refinance, we get into it with the exit in mind. We're going to get the project where it needs to be for an institutional buyer to take that project down if they want to, which means we're getting rid of the asbestos. If there's a dirty phase one, we need to go ahead and mitigate, obviously. But if there's anything in the project that's going to keep somebody from buying it later, lead, asbestos, any kind of anything dirty, we're going to go ahead and clean it up. We're going to make sure the curb appeal is there, the paint is there, the ceilings, the floors. We're going to make it beautiful. Now, it's not built as storage. It is a conversion. You're always going to be able to tell that it was a conversion, but you can still kind of nod to the past while still making it beautiful in its intended purpose for the now and in for the future, and eliminate those obstacles that are going to come back and bite you if somebody's trying to purchase the property later and they're like, well, yeah, but we got to do this, we got to do that. Now we want to design and build everything with a final purchaser in mind in the event that we want to go that route.
Hmm, interesting. And so when you say build it in with a final, let me rephrase my question right here. When you say, what's the difference between what somebody might do if they're not designing with a final purchaser in mind versus you guys where y'all are?
Yeah, it's as simple as things like, asbestos ceiling tiles. And you're like, look, if they're there, just don't touch them. They're going to last forever. That's fine. Well, the reality is that's going to push some people off. So it's worth
Okay.
it to spend a little bit more. Or for instance, like this is a 100,000 square feet is a massive roof, right? That's a huge roof. And a lot of times the temptation is going to be to patch it. If it needs to be fixed, you can patch it versus doing an entire replacement versus doing a core. But at the end of the day, what we want to do is what's going to put a warranty on it, right? We want to do what's going to put a warranty on the roof that in the event that we discern to turn around and trade the property, that it's on there and it's covered. And that was one of the things that on the deal that we did trade, the roof was potentially going to be a deal breaker on that. But we had done upfront the work that it took to make sure that it was not only taken care of, but it was warranted and in place just in the event that we wanted to go that route. So it's the little things. You have to keep this in mind. The idea of taking a giant box and chopping it up into a bunch of little boxes and renting it out is not exactly rocket surgery. That is the easiest conversation. That's a no-brainer. I get it immediately. The actual practice of pulling that off is very challenging. These buildings are not designed as storage. So from the electrical, the mechanical, the roofs, the buildings, the egress, everything in between firewalls, phase one, phase two, it's very challenging. It looks simple, but it's not. So along the way, there are corners that you can cut if you want to, and people probably wouldn't even know about them or wouldn't find out for a long time. But the institutional quality buyers that are coming in, picking up portfolios of these properties for 100 to $500 million at a pop, that matters. And so we
Yeah,
want to
that's
build
who
with
your
the
buyer
end in
is.
mind. Yeah, if you want that compressed cap rate that's going to lead to the increased value, you better build it with that purchaser in mind. And that's
Yeah,
institutional level money.
I like that. That's the easy way of thinking about it, right? What does the institutional guy want? They don't want headache. They want warranty. They want easy. They don't give them reasons to back out of the deal.
Yeah,
I'm curious how your capital stack works. You mentioned that you guys do a refinance. Y'all refinance all your investors out. Nobody pays taxes. Now, with y'all's LP capital, are they getting all their I mean, they're getting refinanced out, so they're getting their money back, which is a taxable event, or do you have them set up in the event where are they still getting depreciation benefits even though they're getting paid
sure.
out of the deal? Or are they still staying in as I'm just curious if they're having to pay taxes on that. I get it as a general partner when you refinance out and it's debt, you're not paying taxes on it. But as an LP, if they get all their money back and profit on it, is that a taxable event, or have y'all figured out a structure that kind of circumvents that as long as y'all own the asset?
Yeah, so obviously I want to be careful about the way that I answer this because I want to make sure that I'm transparent and ethical about all of it. And I would say this, we never do any of our projects without at least three exit strategies in mind. We could refinance, long-term hold the property, we could sell the property, there could be a partial buyout, there's a few different things, there's waterfalls in place and things like that. And we've done different projects differently. Our initial strategy was get a rock solid basis by buying these buildings dirt cheap for a fraction of the replacement cost. We're getting the land and the shell of the building for a fraction of what we could just build the shell for. So there's your basis. Then we're going to improve it, convert it to a different asset class, which changes the formula by which it is now valued. It's now valued based upon a net operating income approach as opposed to a price per square foot approach. And then it hits a multiplier and that astronomically increases the value. So that low basis is what gives you the opportunity to do the refinance. Now, sometimes we will straight up sell a property. Sometimes it's nice to be able to just really inject a lot of capital back into your investor base because you know a large chunk of that is probably coming back on the next project. It builds track record. It's good for morale. And obviously everybody wants to get paid. On the projects where we do the refinance, let's say we needed to raise $3 million from our investors. So Nomad Capital puts in, we put in a certain amount. It varies from project to project. And then say we're going to raise $3 million from LPs. Well, that money that comes in, those people start earning a preferred return from the day that the capital is deployed on the project, but it's accruing because you remember the building is not cash flowing. It's going to take us 10 to 12 months to build it out and convert that to storage. Once we convert it to storage, it's worth a lot more, but it's empty, right? So now we got to fill it up. So we can sell a project early and make several $1,000,000 and do well, or we can take another 2 to 3 years to fill it up, stabilize it, and add several million more. And so the options are we can't refinance and give everybody their money as soon as we do the conversion because we can't cover the payments. There's no cash flow on the property. But what we can do is we're usually sitting around 40 to 45% loan to value at the conversion at certificate of occupancy. And so then once we fill it up, we could do a refinance to about 60, maybe 65% loan to value. So let's say you put in 100 grand, and let's just say at the end of that time period, you're getting back like 250, right? So it's going to be like your 100 grand and then another 150 on top of that. If it's coming by way of a refinance and we are refinancing a property that you are part owner of, and we're pulling millions of dollars out and we're divvying that back out to ourselves and to the investors first, no, you don't pay taxes on that because you still own the property. If we pushed you out of the deal, we're like, hey, man, here's your money back. Obviously, you don't pay
Yeah.
any taxes on the initial $100,000. Here's another 150. And if we push you out of the deal, that's a capital gain and you pay taxes on that. But if we refinance the deal, you stay in the deal, you're going to continue to get those quarterly cash flow distributions in the future. Now, they're going to be smaller because we just reset the debt, right? But if you're getting another 150,000 on top of that, that's not a capital gain. That's a refinance of a property you already own. It's the same thing as a BRRRR property where you buy it, you renovate, you rent it out, you rehab it, you refinance, and you repeat it. It's the same thing on a commercial scale. We're just doing it with a small group of people, usually 12 to 18 people per project.
Yeah. Cash is coming in the form of debt. And so you're not
Right.
taxed on that. Very cool.
But not always. It depends, right?
How are you guys using AI in your business? And have y'all built any AI agents yet?
Man, I'm so bad at it. I built out my OpenClaw agent and it took me way longer than it should. And I've been working on my Hermes agent now for like 2 weeks. And I have this recurring issue with the gateway problem that I have not solved yet. We are using them independently in our different departments. The acquisition guys are using it. Our acquisition team is typically underwriting like 50 to 70 deals a week to get down to 1 to 3 a month that we were sending a letter of intent on. And now that has drastically increased. We're specifically looking to search for off-market deals. I use AI daily. In fact, the smartest thing I did was take my personality type from my Right Path business personality sorter. It's kind of like Myers-Briggs or Kersey temperament sorter, but on steroids. And I uploaded that into my Grok agent that I use daily that gives me personalized guidance on my decision making. And like if I know my weaknesses, if I know that, I'm distracted by shiny object syndrome, I see opportunity everywhere, I'm overly optimistic about the future. Like these things that are natural weaknesses for me because of my personality, when
Mhm.
I loaded those results into my AI agent, so it's a sounding board for me and acts as a coach for me and bring me back down to earth. And it's stress testing and getting all my ideas organized and bulletproof. On the personal level, that has really helped. It's also really helped in my marriage with my wife that we are
Yeah.
communicating. She and I both have our results in there. So as our business, we have multiple businesses together, that coaching and that guidance acting as a nonpartisan, like a third party, non-affiliated, agnostic, like doesn't not picking a side, but just laying it out there based upon what it knows we are each good at and each have weaknesses and identifying our blind spots. That's been huge. Outside of that, there's the day-to-day, like how are the guys using it with ChatGPT or imaging with Gemini? Obviously, we're using it for our marketing material, for our newsletters, um, everything like that. I think the personalized agents is something that we could do a lot better at. And I would tell you this, I've interviewed 4 AI professionals on our podcast just in the last 2 months, and I want to continue to pick up that pace and make sure that we're leaning into that space. And the latest intern that we have started Thursday of last week. And now the question of how much are you using AI? Give me an example of how you used AI in your daily life, and
Yeah.
what are some of the skills that you bring to the table? Like that's top of the list for intern questions now.
Yeah. That's going to be the number one skill set people are interviewing for. It's pretty wild. I've built about, I don't know, 25 of them. And I mean, I went from 9 VAs down to one. I mean, it's insane. This thing's literally just replaced my personal assistant. It's doing all the things that I had a personal assistant doing. We have our sales coach agent listen to all the sales calls, and including my sales call. I still do sales calls, and it grades me 1 to 10 on it. And it grades each section, my report, my needs assessment, my value proposition, my closing, my objection handling, and it gives me a score. And it says, here's what you did well. Here's where you dropped the ball. Here's what you did well. And my favorite section is when we don't close the deal. It says, here's what cost you the deal. Here's what was said. Here's what should have been said. And just last week, I got my sales report back because it pings it and sends it to me right after every call. And it said, "This is what you should have said. You should text him this." And I was like, click send. And the guy's like, "Wait a minute. What? So you're saying this?" And I was like, "Yeah." He goes, "I'm in."
No
Boom.
way.
$25,000 sale. Absolutely insane. So that's the kind of stuff, where all your the podcast. I got one agent that does all of the podcast stuff, which is
Yeah.
crazy because I used to have someone go and send it to Fiverr and then stitch it up and clean the audio and put the
Yep.
intro on and clean it up, all that kind of stuff. Then go to Buzzsprouts, post it, write the description, timestamp it. All of that is completely automated with an AI agent. And not to mention, our you mentioned underwriting. Like when we underwrite a piece of land for land development, it takes me 6 hours. It takes sales rep 6 hours. It spits out a report in minutes on
Yep.
everything that you need to know about it. It's insane. It sounds like you guys are doing it for underwriting too. Y'all have trained it on your underwriting model and how to feed
Yeah,
stuff to it and have
exactly.
it
In
spit out
fact,
reports.
we gave it our underwriting model and then asked it to coach us on improving it, and
Yeah.
then finding different ways that we could, asked it to interview us on additional pieces of information that it may be missing, and then give us recommendations as a world-class PhD level consultant in those areas, and then had it continue to build it out from there. So yeah, I mean, a lot of times I find that that's the problem. It's like I don't even know enough to know how I should use this technology, and I think there hasn't been enough focus on you don't have to, because you can ask it and it'll tell you. Like if you don't know how you should be implementing this, then just say, "Hey, with your knowledge of me and what I'm trying to accomplish and our goals here, uh, for people in my position, what are the best, most effective people in this role? How are they using this technology to get a leg up? And like, what's the
Yeah.
strategic advantage and the competitive moat that we can create here based upon what I'm trying to accomplish and the capabilities that you have?" And it'll tell you.
Have you connected your calendar, Gmail, CRMs, marketing, everything to it, and then asked it to do a full business evaluation and remove anything that a human's doing?
No, I'm actually trying to do that on our personal property management company right now, because I don't want to get in and mess anything up in our system with this much investor information. And there's a lot going on here, and we're SEC regulated, right? So we have to be very
Mhm.
careful. So we've got 14 Airbnbs and a property management company that manages ours and another 75. And so within that company, I'm trying to implement a lot of that right now as a trial run. And listen, man, I'm not tech savvy. I would love to have a conversation with you about this stuff outside of this episode, so we're not wasting people's time. But that's the future, and I know enough to not even be dangerous. I just know enough to know for sure that that's the highest return you're going to get for the amount of time you can spend in your business right now.
Yeah. Okay. So you guys are seeing it too, because I'm seeing a big trend right now where it seems like everybody's waking up.
Mhm.
I go pick up my kid in the morning. I go in, he's asleep, and he kind of starts wiggling a little bit. He's stirring around, and then he gets up and he sees me. Then he gets excited, and then if I don't go get him, he starts freaking out. And I feel like we're about to go through those same motions
Yeah,
where everyone right now is kind of
it's a good
wiggling a
analogy.
little bit. And then
Yeah,
they're getting excited about using AI in their business. They see other people doing it. And then they're going to realize and start freaking out because they're going to be out of business
yeah.
because they're competing with AI agents. Like it's fun. It's crazy to think about. So I've got to ask because it seems to be a very hot topic right now. Um, Clint, this has been a great conversation. If people want to learn more about Nomad Capital, self storage, learn more about you, your opportunities, where can they go?
Yeah, the best place is just the website, nomadcapital.us. I would just go there. You can check us out. I'm on Facebook, Instagram, LinkedIn, whatever else. I'm happy to talk to anybody about Airbnb, property management, anything else. I think the biggest thing for us is once we got to the point where capital was no longer a bottleneck, we can raise money to take on the projects that we know that, you have to have those three things to have success in real estate investing: time, experience, and money. But it doesn't mean that you have to have all those three. You just have to have that combination. So if you have a combination of you have capital or you have time or you have experience, you look for somebody else that doesn't have those things. And sometimes when it all comes together, the whole can still be greater than the sum of its parts. The best way for me to network and meet with the right kind of people is to offer education and be helpful to anybody. We're people over profits and relationships first. I think that that creates an abundance mindset. And so anything I can help with, I'm happy to. You can connect with me through nomadcapital.us. If you schedule a call there, it'll eventually be scheduled with me, or you can email me directly, Clint, CLINT, at nomadcapital.us.
Nomadcapital.us. Go check it out. This has been an absolute pleasure. If you're listening, hey, if somebody that you know needs to hear this, please share it with them. Leave us a review. We'll see you guys next time.